Hi, everyone. I'm Rick Bensignor. Today is Tuesday, January 11th, and welcome to this week's In the Know Trader show. On tap for our half hour together, we're going to switch in order, the order that we normally do things. We're going to start off with our market overview of the Dow Jones, the US 10-year, and the dollar index. And then we'll actually make our way into the trader education portion, which we normally start off with, but I wanted to flow right into the sector analysis portion, which are popular futures markets. And those are the ticker symbols beneath for gold, silver, copper, crude, natural gas, corn, soybeans, wheat, live cattle, and Bitcoin futures. So this way, everything will flow real nice. Quickly, to sign up for my weekly ETF Tactical Trader Report or the monthly 7-Eleven Spider Sector ETF report, go to intheknowtrader.com, click on the tab for sign up, and you will have the information there as well as what subscription prices are. We run some very dramatic discounts when you sign up for an annual plan. So check that out at intheknowtrader.com. My email address, rick@intheknowtrader.com. Also, thank you for continuously reaching out for me for the good feedback on these shows and the occasional question that comes in related to markets. I do want to remind you that due to the scope and nature of what we provide for subscribers, that if you are not a subscriber, please don't ask me some individual stock analysis. I'm not going to be able to answer you on that. That is generally for subscribers, and even in a limited way for them. You can imagine what it's like to if every subscriber started asking me, what do you think of stock XYZ that they're interested in. But anyway, best way to reach me, rick@intheknowtrader.com. All right, let's, again, we're going to kind of change the order of things. So I want to start off, let's take a look and just see what's going on in the markets. Here is a weekly chart of the Dow Jones Industrials. Just a full week ago, we made all-time highs to start the year and then faded, obviously. Now, I want you to take a look at this in the sense that with all the talk of what's going on, and as much as, you know, the S&P's pulled back a few percent and technology's pulled back even a little bit more, and of course the Dow has too, it's minimal. We're just made all-time highs last week. And so far, whatever pullbacks we've seen, and the market's actually turned around today, so now you actually have the S&P up. The 10-year is down at 1.76%. We'll take a look at that chart in a second, but the S&P was down this morning as when we're recording now. It's up 12 points. The Dow is down about 25 points, which is, I don't know, 7 basis points or so. And the Nasdaq's up over 100 points, up about 0.75%. So with all the bad beginning or so to what we've seen this year so far, it's still minimal relative to prior price movement. And of course, the Nasdaq's gotten hit harder. But let's take a look here. When we look at the Dow, we look at several uptrend lines that are beneath current price. Price is still above both the conversion of baselines from the cloud, but we did get, looks like a single close. I mean, this is kind of just darn close to the baseline. So we had one weekly close beneath it in November. That was Thanksgiving week, I think, after, or the week after Omicron got announced, the market was hit, and it's actually recovered to new all-time high since. So support above this trend line here. Another trend line is at a higher angle. And of course, we go back to the summertime lows last year where we've got these horizontal dark purple lines. We're essentially getting a pretty strong zone underneath price action where it currently lays, but anywhere in this yellow colored rectangle for the next month, possibly even two, is where the real important support is. And essentially it's right against those June lows or even higher from there. So we see the top of the weekly cloud keeps moving higher. We've got a TDSD line here at 33,741 and those prior lows just beneath. The bearish propulsion momentum level is at 34,113, make that 114. So if you properly get Friday closes beneath this level that they're qualified and confirmed, then you'd expect further decline. Otherwise, that just becomes essentially another support level. So we've really got the most important levels highlighted here, all within a zone of, let's put it at, I don't know, 34.3 down to 33.4 or so. So that 1,000-point range, which is only about 3%, is the main support here. But before you get too concerned about what's been going on, notice prices come back closer towards where we opened up yesterday. So once again, we bounced. Chairman Powell is answering questions right now from the Senate Banking Committee about his reappointment. There are, of course, a few Democrats who are not going to vote for him, including Elizabeth Warren, who's made it clear that she is not a Powell fan. There are a couple other Democrats, but there are enough Republicans who are pro-Powell that this nomination should go through. And I think the markets generally like the fact that Jay Powell will stay the chairman of the Fed. All right, let's take a look at the U.S. 10-year, because this has moved dramatically since December 31st. So we had the big move up last week. Notice that we are stalling right against 1.81%, which in TNX terms is 18.1. There is a propulsion exhaustion level here. Just above that is 18.56, no, 18.58 that says, so roughly 1.86%. To me, you've got to get above 186 to what the last high here before we fell. So the 2019 fourth quarter high is at 197. So anywhere from 186 to 187 is the key resistance here. My guess is if this week closes beneath last week, and next week we close above 1858 in TNX terms, we will probably get the breakout, which ultimately leads to a targeted move at about 2.4 to 2.5%. If you see the inverted head and shoulders pattern that's here, that would measure to something closer to 3.25%. If we were to draw a neckline, so if we did something like from this high, let's see, well, that would have had it broken out already. But, well, even if we did this and we drew this line here, and I'll make it a different color just so it can stand out. So here, if we use this dark colored magenta line as the neckline, you have an inverted head and shoulders pattern here. Go from the lowest low to what the neckline value is there, add it to where the breakout point is, you're measuring about 3.25%. So in my eyes, rates, if you get properly above 186, you're probably going to start the whole bigger move higher and make this a formal inverted head and shoulders pattern. Can't quite call it yet. We've stalled against, again, a propulsion exhaustion level. We haven't taken out the key weekly TDST line. So that, to me, regardless of what this pattern is looking like in conventional technical analysis terms, I'd really want to see the breakout above 1.86% in order to think that this really is going to get going towards the upside. And now support on the downside is in the low 1.4s. Let's call it 1.42% or so, right around where this trend line is, and the propulsion, the bearish propulsion level just beneath there is at 1.41.5. So, right down into this zone here is where support would be now. And that's that for the 10-year. And then lastly, let's take a look at the US dollar index. So this has been stalling now for well over a month against the setup 9 up and the propulsion exhaustion level here, those little blue triangles. So we have faded moves into this multiple times in the note, just as shorter term trades, just suggesting that you could sell 96, anything above 96.5 in the dollar index, and you've had many opportunities to do that, as well as cover lower. I'd probably still use this level as 96. Well, it's just about 96.60, give or take a few pips, as a near-term breakout to potentially get to the top of the Fibonacci box, which is, and there's also on the daily chart a target near 98.30, if I remember. So 30 pips either side of 98 would be the next upside target. On the downside, I would say anywhere from 93.50 down to about 93 or so is going to be right in here would be your initial support level. And notice that MACD is stalling here. They haven't, well, maybe it's just crossing, but yeah, let's see if we can, just curious whether or not it has. Yeah, they're kind of really kissing each other right there. So could go either way. And even if the MACD does cross, you'd want to see more spread than just a little minor cross before really taking a significant position. But you can see why we've been suggesting that, you know, something up in here is difficult for the dollar to get past. Now, if interest rates do move well higher, that should be decent for the dollar, as higher interest rates here would attract a demand for US dollars from outside countries. So that's our view on that. Let's now move to our technical portion. I'm sorry, our educational portion. And as we go back to our PowerPoint, again, we're going to go now into part 3 of what is open interest. So we started this in our last show in December, which was the middle of the month, because remember, I'm sorry, StockCharts takes off the last 2 weeks of each year. So I think it was in and around December 15th or so, whatever that show was, as well as last week we did part 2 in open interest and how to interpret it. Today we'll kind of wrap things up now before we get to looking at charts with open interest and to see how to put the picture together. So one of the things that we had talked about was going to the website cftc.gov. That's the US government's Commodity Futures Trading Commission's website. You'll click on market data and come down to commitment of traders. Then you'll scroll down and get the commitment of traders report, either with or without options included. I'll usually look at the short format. So let's take a look at something like, here's the gold report, which were as of positions of January 4th. So this typically comes out on a Friday, effective with information from a few days earlier, the Tuesday before. And again, you've got the producers, merchants, processors, users. These are people in the industry and considered smart money. Swap dealers are dealers on the street who are taking the opposite side to generally speculative or hedging positions, possibly. So they're not quite what I would call smart money. They're actually more kind of market makers on the other side to either manage money or the producers themselves. Manage money are the larger commodity and futures related funds. And then other reportables are the smaller speculators. For 50 contracts or less of positions, you fall into the other reportables. So again, just to use gold, here's gold, you'll see as the example, roughly 42,000 long positions, but 103,000 shorts, so 2.5 to 1 or so short. Normally there is a short bias to most commodities, as actual hedgers use these products to hedge inventory. Swap dealers here you can see are over 3.5 to 1 short. Managed money is 3 to 1 long, and individual speculators are more than 4 to 1 long. So the speculative side of the market, those who don't use gold for industrial use, but are actually just trying to play the price of gold, are very long the price of gold. And the dealers and the people in the industry are net short. So how do you interpret that generally? That's fine, and speculators can continually push markets. But when you have significant open interest on the long side by speculators, realize that any data point that comes out that's bearish could easily knock this market down quickly, because generally speculators do not have the type deep pockets that those in the industry can carry, and therefore you'll often see them run for the exits more quickly when there's a data point or a change in a chart perspective, something that changes the picture. So here, what it basically tells us is that bad news in gold would probably knock the market down quickly because you got so many speculators on the long side. And that's, kind of a quick look at who the players are and how they're positioned. So we talked about the value of being able to look at the CFTC report. It's open to the public just by simply going to their website. And that way, you know what is going on as far as how they're positioned. So now let's kind of take all this information, go to chart. Let's take a look at gold, for instance, and then we'll make our way through some of these other ones. So I'm going to look at, let's see, do we have a weekly chart of gold here? I thought I did. All right, it's a daily chart. Doesn't matter if it's daily or weekly. This blue line down here is the open interest. When open interest moves up in the direction that price is moving, generally it means that it supports the open interest moving upward. When price is moving upward, generally supports the trend, saying that it's a decent trend. When open interest moves down and price moves down, it says that players on both sides, both longs and shorts, are getting out of the market, getting out of their positions. So what do I take from this now? Well, I took a look at the fact that gold still has been very flat for months and months, minor little moves. And this move was accompanied by a large change in open interest, which immediately turned around and went right back down. So at 500,000 contracts of open interest, that's fairly steady where it's been for a decent amount of time in the last year. So we don't really have much perspective on the gold chart right now. Notice that when gold made its all-time highs in August of 2020, open interest is substantially higher than where it is now. But the move, this was interesting, that the move up in the fall, when gold broke out from first this technical resistance level, this lower of the two magenta horizontal lines, and then continued through the triple top here, open interest grew, which means new longs came in against new shorts. But the longs at the time were making the money and the shorts were losing because the price was going up. It stalled against the downtrend line from the January 2021 high, and then gold came right back off as the dollar continued to move higher, and you saw open interest came right back down. Open interest coming down means longs are getting out to shorts getting out. So both sides of the trade are unwinding, and we're kind of right back in the middle to where we've been. So I don't really take much directionally right now from what this is showing us, and therefore, to me, gold is really not likely even worth trading unless you're a very short-term trader. You're not getting much information, and you take a look at the longer-term gold chart, and not a heck of a lot is going on. The trend line is holding here, and we're getting closer to the apex of this triangle. But right now, actually, I guess my chart hadn't been all the way to the far right, so we are seeing a little bump up here in open interest as price is moving up immaterially. So not a heck of a lot to take from this. Let's see what happens if we go to silver, and if we can get anything from silver. So silver continues to be, look at this, in a long-term trading range. And those are the basic levels that, the key levels. So silver still just beneath $22 is still holding. We're at 22.71 right now. And open interest is still holding steady on this move up here. Same time when gold rallied, you did see the bump up in open interest, but it too pulled right back down. Most importantly here, I take a look at is that silver continues to hold the $22 level. It's at the lower portion of its range. It's been washed out as far as open interest, meaning you're very steady here, and you're not close to where the highs are. So it still gives an edge to the bullish play here, just basically leaning against that $22 or a slightly lower level. I don't know, where is that, 21.80-ish, for a possible move higher. You'd certainly want to see the dollar come off for silver to make any material move higher. But most importantly, just by looking back over a year, you can see what the key trading ranges are and where some of these potential targets and breakouts can be. Let's look at copper. This particular charting package uses CP for copper, but that is not the standard. The standard in the industry is HG, which stands for like high grade copper cathode tubes, I believe. So here, sideways, there are moves here. 475 down to 425 is a significant move on a percentage basis. And if you're trading futures, big move. Notice here on the decline, now we had a double top of 475, and on the decline, open interest fell a lot, which means the longs got out and the shorts got out. So as this peaked and sold off, people were getting out of their positions. The longs were getting out of what they had been long previously. Those short were locking in losses, and well, unless they sold it near the tie. But net, you see that there was a big decline, and then price started stabilizing, and open interest has come back here too. So this is smack in the middle of the range. Very tough to come up with a clear directional trade right now for the price of copper. It's just, within a range. You could always add in RSI chart, stuff like that, to see if you're overbought or oversold. It's at 53 and change. You're smack in the middle of its range. Nothing to particularly take of it, and nothing to particularly take of it from an open interest point of view. Crude oil. So crude oil, massive unwind in open interest starting here. So price went well higher. So what's that mean if price goes up and open interest doesn't go up? It means it's short. It's price goes up without open interest going up, means you're not getting in new longs, new shorts. You're getting shorts covering into new shorts putting on positions. So the buyers are shorts who sold lower, are getting out with losses, and the people selling it to them are actually new shorts coming in. That does not increase open interest, and eventually, when you peak out here, you've got, so that helps you know that this was a short squeeze as compared to necessarily new longs coming in. And then as this sells off and open interest comes off, that's a liquidation on both sides. That means longs got out and shorts got out. And now you're starting to see some open interest build back again, but it's the same thing here. If we look at, here's where price bottomed, but open interest went down significantly after price bottomed. So you still had a lot of people getting out of positions. If open interest goes down, that's longs and shorts getting out at the same time, essentially to each other. And so that didn't bottom until here, even though price had moved up significantly, which means it would have been pretty hard to play that rally, at least not, you didn't know from open interest how to necessarily play. Now you're seeing open interest build up again, which means new longs are coming in and new shorts are coming in. And when price moves up and open interest moves up, generally it gives you a sense that that's a solid, your shorts are losing, your longs are making money. And right now at some point, and you can see oil's at its best level in 2 months, your shorts are in pain and the longs are making money here, and they'll start leaning against some of these old technical levels probably to start taking off some of those longs, just against normal resistance levels. Let's take a look at, let's see, we got 2 minutes left or so. Let's move out of this space. We'll look at, I don't know, let's try corn. Here we go, daily corn. So open interest peaked in February, price went way higher. If open interest peaked and price went way higher, these are shorts getting out, and shorts getting out to longs getting out, because open interest went down, but the shorts were so much in pain, they were far more aggressive. This is like, heck, get me out. I don't care what price, just buy the stuff and get out of my losses. Open interest, interestingly, peaked around here, price-wise, and now sold off and bottomed, let's say about here, but price still went down another 10% before eventually turning around. You got this sell-off in here that matched this liquidation here. Longs and shorts both got out on this pullback against kind of this level. right? Kind of triple high area, pulls back, but now we're hovering right above it. Any new surge up, you've got a huge gap here, is going to probably wipe out some shorts and potentially bring new longs in, but that's not going to that would not change open interest, right? We've talked about that. And then we'll get out of the grain space just to look at something else. And here, let's look at, well, heck, we'll look at Bitcoin. Bitcoin open interest peaked on this high, comes off, makes a new higher high. Open interest did not make a higher high. Those are shorts getting squeezed. They're paying up to new shorts coming in. How do we know that? Because open interest did not move up materially. So that means these are not new longs coming in. This is most likely shorts getting squeezed out into a new all-time high. We told clients here, regardless of the fact that you had made new highs, we were sellers here. Almost every other technician I know was buying Bitcoin on this breakout. People do podcasts on this very network. I heard buying the Bitcoin breakout, we were selling it. And now you see what Bitcoin is here, and we're up against prior lows. So, important support down here. You've had a general decline in open interest for this point, and therefore the decline means longs were getting out and shorts were covering. So at this point, I kind of look at these levels here, and you play against their old highs in here near 40,000. There's lows. It should have a technical bounce here, and you are seeing that happen now. That is our show on open interest. It's been a 3-session part. We hope you've enjoyed it. I'm Rick Bensignor, and this is In the Know Trader.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.